Morning, good afternoon. Let me introduce Canaccord to you guys. So I'm sure if you've been part of these webinar series that's been running through COVID times, you'd have heard Justin speak numerous times. So Justin Oliver, Deputy CIO Canaccord, he's going to be presenting to us today for the outlook for 2021. We also have Head of International Sales, Richard Burden, who I'm going to pass over to now. Richard, over to you. Thank you very much for doing this again, guys. We're really looking forward to this one.
Thank you very much, Alex, for the introduction. Canaccord Genuity, just as a summary, are a global investment house that specialises in providing outsourced investment solutions. And we currently manage almost 30 billion on behalf of our clients and institutional business partners. The investment oversight that goes into supporting our asset allocation and portfolio construction is led by our Chief Investment Office, which Justin Oliver is Deputy CIO of. It is worth noting that this approach and investment oversight led to exceptional performance of the funds during 2020, outperforming our competitors and peer benchmarks. The CGWM funds that benefit from this investment oversight have been in existence for nearly 20 years, so through various bull and bear markets. The investment oversight that goes into supporting our asset allocation and portfolio construction is led by Justin Oliver. And I'm very, very happy to pass over to Justin today, who will present.
Thank you very much, Rich. Thank you, Alex, for the introduction. And thank you all to you for dialing in this morning, this afternoon, or this evening, depending on where you are in the world. So again, as we've done in the past, we just want to talk you through our latest views and thoughts in terms of markets and sort of investment strategy. And you'll notice that we've titled today's presentation Navigating a Post-Pandemic World. Now, we don't want to leave you with the impression that suddenly we're going to wake up one day in the next month or so and everything will be back to the way we sort of lived in 2019. As we'll sort of show, that the progress we're likely to see over the year will be gradual, but it will be continual. And I think, again, some of the data which is coming out does lead us to the conclusion that certainly by the end of the year, we'll be certainly much closer to the way we're living in 2019 than we were at the beginning of the year and for much of 2020. And again, as we've done, what we're going to try to do today is just sort of split the presentation into three areas. One is looking at the coronavirus situation and probably some of the most important developments there. We'll then take a look at the economic developments, and what's going on in terms of the global economy. But really today, the main focus is going to be on financial markets. And there's a few things going on which we think is going to be very important for investors to certainly be aware of in 2021, because they could make quite a large difference to investment returns. And again, just to give you some sort of sense of what we're thinking and those sort of decisions that we're trying to, we're discussing as a team, and that in some cases that we're implementing within our portfolios. So with that, I'll share my screen with you. And obviously, as I said, we've titled this Navigating a Post-Pandemic World. Now, I think probably the most important slide I'm going to show today is this one. Now, this isn't then an invitation for you to sort of click off the seminar after we've finished this slide, but this is really, I think, a crucial slide and one of the most important developments. And this is just basically looking at the number of coronavirus cases that there have been throughout the world, and then looking at the vaccination program, which really started in earnest towards the end of last year. And you can see that from a standing start, very, very quickly, the number of vaccine doses administered has quickly surpassed the number of new cases and coronavirus cases that we've seen. And clearly, as we go throughout the rest of 2021, that gap is only going to get bigger. Now, it's not to say that there won't be roadblocks or bumps along the way. We've already kind of seen that in some way, in terms of there was a little bit of spat between the UK and the EU in terms of vaccine production and vaccine availability. Germany, I think at this moment in time, Europe's been quite slow in terms of their overall sort of vaccine program. Germany's still got a surplus of the AstraZeneca Oxford vaccine, and they haven't really used that much. Again, there's a few doubts about its effectiveness. But with that, a lot of that we think is effectively noise, and ultimately, the large picture and the most important picture is the fact that the vaccines will be rolled out and are continuing to be rolled out across the world. Different countries clearly working at different speeds. Israel and in the UK at really the forefront of the vaccination program. And of course, then there are some of the moral issues which are arising at this moment in time, particularly in the fact that it's been the less vulnerable people in the developed world will be vaccinated before some of the more vulnerable people in the emerging world. Now, clearly, again, from a moral perspective, that's very difficult to justify. But again, that's a social issue rather than one that we're trying to focus on today, which is in terms of looking at financial markets and the global economy. So again, that program will continue. Again, there's a few doubts in terms of effectiveness against new varieties, how long the protection will last. Again, those are questions that we don't yet know the answer to. Against indications that against the South African variant and the UK variant, that the vaccines will still be effective, maybe not as much as against the original virus. But again, it's a positive picture that the vaccine is being rolled out, and we can look forward to a return to some sort of normality and an increasing return to normality as 2021 progresses. This is just again a snapshot at one particular time of various countries and their both availability of the vaccines. So how many contracts that they signed from the major drug manufacturers, and you can see again in most cases. Many of these countries have supply agreements in place for more vaccine that they will potentially need. So again, you would hope that as the program develops and as some of these countries move towards full vaccinations of their populations, that some of that production will be spread out across the developing world. And what we can then do is bring everything together and look at this moment in time. Where's the best place to be living in the coronavirus world, which we're still effectively living in? And is that starting to inform us about economic prospects moving forward? So this is something which Bloomberg put together on a monthly basis. And it just really looks at a variety of factors, not just the coronavirus cases themselves and the infection rate, but it's also looking at things like the access to vaccines that various countries have, universal healthcare coverage, and actually how far along in that vaccination program the various countries are. Again, it's going to move quickly out of date. Certainly the last one, the doses given per 100 people is going to be out of date quite quickly. As we know, the UK is around 15 to 17 million, I think, from the last time that I looked, so well over 25%. So again, it gives you some sort of indication in terms of countries like the UK, how quickly the population is being inoculated. What's notable to us from measures like this is if you look at the top 10, 8 of those top 10 are countries in the Far East and Asia. A couple of Northern European countries as well. Again, really that reflects the fact that actually Asia has generally handled the pandemic much better than other countries, certainly in the West, like the US and the UK. And again, we think that's going to continue to provide a tailwind for economic growth moving forward, particularly in 2021. So just taking a look at the economic outlook, we've kind of been of the opinion that the economic data, certainly over the past 12 months, hasn't really told you too much other than what happens when you lock down your economies, which is effectively that growth grinds to a halt, and then what happens when and if you can reopen them to various degrees. And clearly then you see some quite strong growth numbers starting to come through for a period of time. These are just This is data from the IMF, who look forward into sort of 2021 and 2022, and again trying to get a sense of which economies are likely to be growing the most strongly moving forward. Obviously, looking back also in 2020. So last year, again, unsurprisingly, most economies actually contracted. The standout was China, which was able still to grow its economy by 2.3%, which was still its slowest growth rate in over 40 years, but it was one of the very, very few economies which ended 2020 larger than it started the year. The IMF again have been looking forward, and actually in the economies which are expected to recover most strongly and more quickly recover their 2019 highs are China again and the US. Now they're achieving that in very different ways. As far as China is concerned, they managed the pandemic very well once it took hold. They were very quick to lock down their economy and very quick to prevent movement both within and into the country, and just generally they handled the pandemic well. But as a result, they haven't needed to provide lots of the economic stimulus that we've seen across other countries in the world. The US was the opposite end of the extreme. It didn't handle the pandemic very well, to the extent you might have seen over the past couple of years that we reached that sad milestone where there were 500,000 deaths as a result of coronavirus in the US. But what they have done, and to an extent much larger than other countries, is provide massive amounts of stimulus, both in terms of central banks cutting interest rates and restarting their quantitative easing program, and also in terms of the government. They've been spending lots of money in terms of supporting the economy until such a stage as the economies can be reopened, which has clearly been dependent on vaccines and lockdowns being removed, really to get economies and the corporates and households through that difficult period until they can stand on their own 2 feet again. Again, what's notable to us compared to the last crisis which we had, which was the banking and financial crisis of 2008, 2009. Following that crisis, growth in the world was actually quite slow. It's very difficult to gain traction. This time, most economists and people like the IMF are expecting growth to rebound, quite significantly and in quite a large way. And that really reflects two things. One is that actually it is coming out of lockdown, so you are going to see this, activity start or almost beginning again from a sort of standing start. But also it's a reflection of the fact that actually the stimulus this time has dwarfed what we saw in 2008, 2009. So we're looking at what's happened in terms of central banks. Interest rates got cut very, very quickly, and many central banks began a quantitative easing program of buying sort of government bonds, etc. But actually, that's largely also what they did in 2008, 2009, albeit the movements this time, they were quicker to cut interest rates, and the bond buying programs that they've done were larger than we saw in 2008, 2009. The biggest difference this time is what governments have done. Actually, governments last time didn't provide the amount of fiscal stimulus that they have done on this occasion, which actually it was a policy mistake and was part of the reason that growth was subpar for so long following the financial crisis. There was a focus on austerity, which actually, and the focus on austerity was all about, in their eyes, trying to control the amount of debt which was being built up. But actually, that can be a self-defeating program, because actually, if the government is the only source of support, the private sector is effectively retrenched and isn't spending anything. The government is there really to try to take up some of the slack, but they're becoming austere. They're not spending much. And actually, the situation you can get to is that the debt continues to increase at a faster pace than the economy is actually growing. So actually, by implementing austerity, the debt to GDP ratios can actually worsen, not get better. Governments seem to have learned that, or maybe it's just because actually the crisis in this stage hit the high street, it hit the real economy, and wasn't just a banking and a financial related crisis. We can see actually even nations which are typically quite frugal, like Germany, have been spending like 35 to 40% of programs, 35 to 40% of their GDP on programs of both spending and also putting loans and injections into the economy to try to support economic activity. Looking at the US again, because it's the world's probably largest economy, it does matter for the world. And again, here we're seeing this is even before Joe Biden's new spending plans, which are going through Congress at the moment. The spending has been about $8.5 trillion US dollars when you add up both the central bank action and what the government has done, with the expectation that at least another $1 trillion is going to be injected into the economy at some stage this year. Clearly, Biden's initial plans were about for $1.9 trillion on top of the $8.5 trillion, which has already been earmarked. Whether he gets that through or not, again, is kind of still an open debate. The most contentious issues seem to be raising the minimum wage, so that's at $15 an hour. But ultimately, there will be further stimulus coming through, and there will be further stimulus coming through in the world's largest economy, which makes such a difference as far as the global economy is concerned. Now, that's again all fine. We've obviously then got we've got some difficult decisions, and there's a debate to be had about, okay, lots of debt has been taken on. How is that debt going to be paid down? How is it going to be paid back in the future? Because we have known, obviously, governments have had to take on some large amounts of debt to get their economies through that. This is one of the great unknowns at this moment in time. What we've shown here on the left-hand side is the fiscal deficits that are being run in both the US and advanced economies as a whole. So governments are spending more money than they are taking in. And certainly the support that's provided in 2020 far surpassed anything we've seen in the past. 2021 is still not going to see a return to surpluses, albeit slightly better than we'd have seen last year. But as a result of that, the government debt around the world has started to increase. It started to increase to quite significant levels. So how ultimately is that going to be paid down, or is it going to be paid back? Actually, do governments need to worry about paying that down? Particularly if you look at things like Japan, where actually their government debt to the size of their economy, so the same sort of metric that we're using here, actually that far surpasses anything we're seeing in the US and the Euro area, because they're actually Japan for a number of years has had a debt to GDP ratio of well over 200%, but hasn't run into any financing difficulties because actually interest rates in that economy have remained very low, and the Japanese government hasn't had any problems in terms of servicing that debt. So actually high debt isn't of itself an issue. It's also actually what you're being asked to pay on those debt levels. Our sense at the moment, again, this is probably more a question for 2022, 2023, and maybe when the market's going to start focusing on these sort of debt levels. The sense is that those debt levels will be reduced probably by one of two ways. One is growing the size of their economies at a faster pace than debt is increasing. And the other one, and again, this is one of the key slides that we'll show you, very shortly, is in terms of inflation. I think it's reasonable to expect that inflation will start to accelerate. It certainly will accelerate this year, but as a longer term theme, as investors, we are probably going to have to get used to higher inflation levels than we've been used to in the past, actually 35 to 40 years. Again, so there will be implications in terms of investment selection if we do see a higher inflation environment moving forward. So actually, let's turn to inflation. And as I showed in the coronavirus section, it's the vaccines against the coronavirus cases, which was the most important slide. I think in terms of the economic situation, this is the most important slide. It's what happens to inflation moving forward. And it's a subject of sharp debate in financial markets. And actually, it's a situation where I could easily be speaking today, and I could make a case to you for both inflation being much higher moving forward, or actually inflation being, as we've kind of expected, as we've seen it over the past few years, and actually remaining quite weak. So if I was making the case for the fact that inflation is likely to accelerate, first thing I point out that inflation is certainly going to accelerate this year, and certainly over the first half of the year. It's almost a mathematical certainty that it's going to, because inflation is constructed on a year-by-year basis. So as we go into March, for example, March last year, the oil price had collapsed given the retrenchment in global activity. But now we've seen, obviously, oil prices at over $60 a barrel. So actually, when you're comparing the situation in March this year to March last year, clearly you can see that oil prices will be significantly higher. And that will be the case for many goods and services. So it is inevitable that inflation, particularly in the US, will accelerate, certainly over the first half of this year. Here we're more talking about the longer term picture. We're talking about the 2022, 2023 sort of scenario. Now, if I'm going to talk to you about inflation and why I think it's going to be higher than we've perhaps used to, I'm going to highlight the fact that actually lockdowns will be slowly reduced during 2021 as the vaccines are rolled out, probably just at the time when all this extra 1.9 trillion US dollars in the US is starting to hit the economy. So clearly that's a massive inflationary and demand wave, which is going to impact the US. We're also seeing lots of money printing. It's reasonable to expect the US dollar is going to decline moving forward. Again, that typically feeds through to higher inflation. One of the other things that the world has benefited from is the integration of China into the economic system. And actually, China's been a very powerful deflationary force because it's been able to flood the world with goods which are produced at very cheap costs. Actually, there's an argument to say that actually moving forward, that force from Chinese deflation has probably peaked, and going forward, it might not be the dampening effect on inflation that we've seen in the past. There are still likely to be ongoing supply chain constraints, and actually maybe we've seen peak globalization. And maybe the world will become much more localized. Certainly, if you're thinking about what governments will be thinking about in the years ahead, and if there's another pandemic, for example, it's likely that they'll want to be relying on their own resources a lot more to make sure that actually if there is another vaccine required, etc., that they're not relying on other countries to supply any part of that, whether it's in terms of the goods and in the supply, products, whether it's the plastics which go to make the vials, etc., etc. I think you can reasonably make a case that governments will want to become much more self-reliant. We have seen a massive increase in unemployment over the past 12 months. Going forward, it's reasonable to expect that actually the employment picture will start to improve, and therefore it would be reasonable to expect that actually demand will increase and inflation will come through. Actually, also the most important thing is that central banks, and particularly in the US, have said they want higher inflation, or they're prepared to accept higher inflation moving forward. The Fed is now working on an average inflation target, which means that if inflation has undershot what they're aiming for, which it has done over the past few years, they will allow inflation to overshoot over the coming years to offset that period when inflation was much lower than they'd hoped. So on that basis, average inflation is going to be higher than perhaps we've been used to. So that's the case for inflation pushing higher. You can also make a case for actually why inflation is going to still remain quite low. you can point out the fact that, yes, whilst the economic backdrop is improving, it will still not be in many countries where we were in 2019. Whilst the employment situation is improving, there will still be lots of people who don't have jobs, which they previously had, and therefore the unemployment rate will not fall down to what we saw in 2019. You can talk about the aging population and what that does for typically for demand. The forces of technology and automation, which all have acted to dampen down prices. Again, that's not necessarily going away. And actually the low interest rate environment in which we're seeing ourselves means that actually many companies which would otherwise go out of business are kind of being kept afloat by the fact that they can borrow money at a very cheap rates, which means they're an unproductive part of the economy, which again would tend to dampen down inflation. And also the fact that debt has been taken on. Again, debt does tend to have a dampening effect, particularly if governments again move back towards that more move towards austerity moving forward. Again, just to highlight, both sides of the argument. If I was going to make the case that actually inflation is going to remain low, I would point to the fact that this is the augmented unemployment rate. So it's not just people who are unemployed, but people who are taking themselves out of the workforce, but would actually take a job if it was offered to them. And you can see actually, if inflation wasn't a problem when the unemployment rate was down at these sort of levels, is it really going to be a problem when unemployment is so much higher now? That's a valid argument. But also you can make the other case and say that actually the stimulus which has been applied by governments and the money which has been given to households, in many cases that has just been saved. And actually, even if you've got a job, there's been an increase in almost precautionary savings. So if you're looking at the savings which are underway in terms of the US and German economies, you can see actually it's quite high, which means that when economies are removed from lockdown, there's going to be massive amount of pent-up demand, which is available to go into buying goods and services, which is ultimately going to feed through to inflation. Actually, I think both arguments have got validity. And quite frankly, at this stage, no one has really got a clue about what's going to happen to inflation. I think when we have our discussions as an investment team, we're probably more erring towards the side of expecting inflation to be higher than we've been used to it over the past few years. But I think any expectations that we're likely to get hyperinflation or double digits levels of inflation will be wide of the mark. We're certainly not expecting that moving forward. A couple of quick comments in terms of other things that we need to take into consideration. One is sort of Joe Biden. I think we are taking some comfort from the fact we've now got a grown-up in the White House. Some of his plans will become, do have implications for inflation moving forward. Democrats typically have a higher spending plans than Republicans. Some of that will be paid by higher taxes. But again, just looking at some of his plans and what's expected to happen there, of the 1.9 trillion which is being discussed in Congress at the moment, 850 million of that's likely to go direct to the consumer. We've got another 600 billion to go through to local government support. So that's a massive amount of support in a very short space of time. And again, it's not unreasonable to expect that will have inflationary repercussions. The other thing just to keep an eye on is the ongoing tension between the US and China. Just because Donald Trump is no longer in the White House doesn't mean that those tensions are going to go away completely. It's actually a vote winner in the US to be seen to be hard on China. It's just Biden's going to deal with that, we think, in a slightly different way. And again, there are going to be continuing tensions moving forward. And again, that might serve just to increase volatility from time to time. And again, we've seen that over the past couple of days in terms of the US and Canada and a couple of Canadian nationals being held in China at the moment. So those sort of geopolitical issues will, I think, not be quite as severe as perhaps Donald Trump's tweets caused, but will still be going on in the background, and it's something we're going to have to keep an eye on. So just talking turning now to markets, the final part of this presentation. I think this is where lots of interesting things are going on, and this is clearly what we're focusing a lot of time on in terms of our investment strategy. What's happened over the past year or so, past 15 months or so, this is just looking at financial markets since the end of 2019. If you've listened to us talk before, again, this will be very familiar to you. What's been the best places to be invested in? Yes, technology, the companies which benefit from working from home and staying from home, Asia and China in particular, which partly reflects the fact that from an economic perspective, those nations handled it quite well. And also US small caps have also performed extremely well. Again, expecting a pickup in activity during sort of 2021. The areas you haven't want to be invested in are Latin America, which is, because it's quite commodity sensitive, was impacted by the collapse in commodity prices last year, and also the fact they haven't handled the pandemic particularly well. And also UK equities have been a notable laggard, reflecting both Brexit and the composition of the UK stock market, which has been out of favour. But actually what's made as much difference to where you've been invested regionally is the types of stock that you've been invested in. So in an environment for 2020 where growth was quite difficult to come by, investors were prepared to pay ever higher multiples for companies which could demonstrate that they could continue to grow. And that was very much in the tech space. So those work from home, stay from home stocks like Facebook, Netflix, Google, etc., etc. What markets didn't want and weren't particularly interested in were companies which were trading at a cheap level, or those that were offering dividends, because we saw there was a situation last year where dividends were cut across many companies, either because they felt they didn't have the visibility of earnings, or in some cases in terms of financials, because there was regulatory pressure to do so. So you very much wanted to be in that sort of growth camp and stay away from value stocks and stay away from dividend payers. Actually, I think moving forward in 2021, that difference between the top performers and the bottom performers will narrow, and we wouldn't be surprised to see value stocks and dividend stocks certainly take up the mantle of stock market leadership moving forward. And those sort of stocks which benefited as we were working from home won't necessarily be the winners when economic lockdowns are starting to be reduced once again, and we're getting back to towards some sort of normality. We've kind of seen a little bit of that rotation since the first vaccine trial data was released at the beginning of November. Hasn't quite taken hold quite yet, but again, we think that'll be an important thing to consider moving forward. So, as a result of that, what else can we say about stock markets in particular? We can say that actually the US stock market is looking expensive at its current valuation levels. So this is a price earnings ratio of the market, forward price earnings ratio. And you can see here it's trading at sort of 22 times earnings, which, and the last time it was trading at these sort of levels was the end of the 1990s, which was at the peak of the technology boom and subsequent bust. And it's certainly trading well above its average level going back to 1990. So the US stock market isn't looking cheap by this measure. Actually, it's looking even more expensive if you look at ratios like the price to sales ratio. Some people prefer looking at price to sales because sales in a way are much more difficult to kind of massage than earnings. And again, many companies have perfectly legitimate ways of either dampening down earnings or increasing them if there's a particular picture that they want to present. Sales is again another way of looking at valuations. And here you can see actually on a price to sales ratio, the US stock market has never been as expensive as it is at this moment in time, and certainly well above its average levels. If you bring everything together, so that on the left-hand side is the size of the US stock market relative to the size of the US economy. So this is Warren Buffett's favorite measure of stock market valuation. Again, the picture being presented here is that the US stock market is not cheap and has never been as expensive as it is at the moment. On the right-hand side, this is a chart we got from one of our research providers, which looks at a variety of valuation measures, whether it's price to sales, whether it's EV to EBITDA, etc., and just looks how expensive the market is relative to its own history. The more the box there is towards the right-hand side, the more expensive it is relative to its own history. And in most cases, the market has never been as expensive as it is at the moment. There is only one measure by which you can say that the US stock market offers value. Actually, thankfully for us, I think thankfully for us as equity investors, it is the crucial one, however, but it does explain why the market is so focused at this moment in time on the inflation picture and what the US Federal Reserve is doing. So the measure which you can say actually the US stock market does have support is if you look at it relative to long-term interest rates. So all other things being equal, higher stock market valuations can be supported if interest rates remain low. And interest rates will remain low as long as inflation remains controlled. And every indication that we're getting, particularly from the US Federal Reserve, indicates that they're going to be very, very slow to raise interest rates. Any increase in inflation is likely to be looked through because it's going to be viewed as a temporary phenomenon. And even yesterday, when the Fed chairman Jay Powell was talking to Congress, again he was at pains really almost to paint a downbeat message in terms of the US economy and trying to just soothe markets' fears that interest rates are going to go up anytime soon, because they're certainly not. So if you're looking at the longer term, so this is the cyclically adjusted price earnings ratio. So it's looking at earnings over a 10-year period to try and smooth out some of those fluctuations that we see. Again, you can see actually it's trading expensively relative to its own history, 34.5 times. There's only been a couple of occasions when the market's been as expensive as it is right now. One of those times was at the end of the 1990s, the peak of the TMT bubble. The other was 1929, which is obviously just prior to the great market crash. So actually the market's looking very expensive now, but actually what is supporting it is the fact that interest rates now are so much lower than they were at the end of the 1990s, and actually if you're going back to the 1930s as well. So another way of looking at that is to look at the earnings yield of in this case, the S&P 500. The earnings yield, which isn't to be confused with the dividend yield, the earnings yield is literally just the inverse of the price earnings ratio. So if the market's trading on a P of 20 and the earnings yield of the market is 5%, if it's trading on a P of 10 times, then the earnings yield is 10%. So actually the key difference between now and particularly towards the end of the 1990s, because there are lots of people out there who are fearful that actually what we're going through is very reminiscent of the end of the 1990s. The key difference now is that the earnings yield on the stock market is higher than it was, in terms of the 10-year Treasury yield. That was different to what we saw at the end of the 1990s, when the yield on Treasuries was higher than the earnings yield of the market. And this is probably shows in a slightly better way. Again, a massive difference between now and the situation we saw at the end of the 1990s. And as long as this picture doesn't change, then actually the US stock market can remain supported. As we do know that valuation is and of itself a very poor timing tool. Markets can stay overvalued and undervalued for an extended period of time. And certainly as long as this picture doesn't change, there's no reason to expect that we're likely to see a new bear market or anything like that. But again, there are a few things that we need to keep an eye on. One is if we think the US stock market, and there we're looking at the S&P 500, if we think that's expensive, you should look at what small caps are trading on. So the Russell 2000, which is an index of small cap stocks, really since the midway through December last year, actually hasn't had a PE because the losses of its constituent companies have more than offset the profits which are being generated. If you're looking at the S&P 600, which has more stringent criteria in terms of the companies which it allows into the index, here we're trading at a P of 65 times, which is, I don't need to probably tell you, very, very expensive. And then we've got a few sort of things going on the sidelines, which again, partly I think why there's a lot of focus on, is the situation now like we were at the end of the 1990s? And that's what's going on in terms of particular tech areas. So one of the areas that clearly has been of benefit has been the performance of FANG stocks, so here, or technology stocks. FANGs being Facebook, Amazon, Netflix, Google, and the plus includes a couple of Chinese companies as well. And again, you can see actually those companies have performed extremely well. The argument is, can that sort of growth rate that they've seen, both in terms of their profits and the share prices, continue? Well, clearly it can't continue at this sort of pace forever. And you could make a case that actually too much good news has already been priced into these companies. We're seeing a few other things come in. Companies which are floating on the stock exchange now are actually very, very young, typically, without much of a sort of necessary business plan, or without much of a track record of profitability. Again, that's one of those sort of slight warning signs from us, again, having been through this period before. Actually, once you're floating companies with a very short track record, it's sometimes a sign that animal spirits are taking hold a little bit sort of too much. And then we can turn to issues like Tesla and what we've seen there, and Bitcoin or cryptocurrencies. Again, I just want to make a point. This is not disparaging either Tesla as a company or Bitcoin or cryptocurrencies per se. You may well be holders of some cryptos. You might hold Tesla, in which case you've enjoyed a fantastic, certainly a fantastic year, or if not a fantastic couple of years. We're just sort of pointing out, actually, these are to us some of the signs that that there is a bit too much animal spirits maybe in the market. And again, one of those signs that actually stock market bubbles always, or bubbles in financial markets, always develop following a period where interest rates, and particularly in the US, are kept at a too low a period for too long. And actually, maybe these that sort of bubble-like properties are becoming evident in stocks like Tesla, which is now the world's largest car company by market capitalization, $650 billion the last time I looked, if not by the number of cars it produces. And here you can see actually its market cap dwarfs what we're seeing from more established companies like Ford and GM. I've no doubt that electric vehicles are the future. Am I as convinced that I'll be driving a Tesla in 10 years' time? Maybe not. Now, again, I've seen research which supporting the fact that actually Tesla could well be a $1.5 trillion company, and in 5 years it could be worth $3.5 trillion in 10 years. No, again, that might be perfectly feasible. It's just, to us, actually, those sort of price rises and that price action that we're seeing there is slightly reminiscent of a bit too much exuberance in certain areas. And again, in terms of Bitcoin, Bitcoin and cryptocurrencies are not something that we invest in within our portfolios, not least because regulators are dampening down on the ability to buy cryptocurrencies, because quite frankly, it's in their best interests to try and keep cryptocurrencies as a relatively small part of their economy. And again, just sort of highlighting, actually, certainly with companies like Tesla, again, it may well be a great company, but it's the price at which you're paying for these investments which makes the most important determinant of future returns. So we look at Tesla, what it's done over the past year, and you compare that to what certain technology companies did in the last year of their tech bubble at the end of the 1990s, you can see that Tesla has massively outperformed. But the fact is, if you bought Cisco when it peaked in March 2000, in actually share price terms, you actually haven't made any money as of today. Just in total return terms, you've made something in terms of dividends, etc., coming through. But similarly, if you bought Microsoft in December '99, I think you had to wait something like 15 years until you were back in a profit. Amazon, again, done fantastically well over the past two or 3 years, and even longer than that, to be fair. But actually, if you bought it in December '99, you had to wait 10 years until you were back in a profit again. And in the meantime, the shares had collapsed by something like 90%. So all we're saying here is just mind your eye on certain investments and certain parts of stock markets, because it is the price that you pay, which is an important determinant of future returns. And again, just looking at what Bitcoin's done compared to some of the other asset bubbles that we've seen over the past few years. Asset bubbles do occur actually with regularity in financial markets. And again, we've been used to them in the past. Actually, what we're seeing in terms of Bitcoin is a massive outperformance of even some of those spectacular returns. Look at more fundamentals. We're going through the US reporting season at the moment, and actually it's been very good. Most companies have surpassed their expectations, and that we're expecting 2021 to remain a good year in terms of company earnings, which again actually will help the stock market, because what we do know is actually over time, unsurprisingly, there is a correlation between share price performance and company profits. So again, that's an encouraging development. One of the things that we are starting to look at, however, is to rotate our portfolios away from those areas which have done very well for us, and perhaps towards more those unloved areas and those areas which underperformed in the coronavirus pandemic. And that's sort of leading through to the whole growth versus value debate. Now, value stocks, which you can think of being financials and energy, have underperformed significantly over the past few years, and particularly during 2020, when investors were just focused on anything to do with growth. To the extent now that actually value's underperformance is as pronounced as it was again at the end of the 1990s, when investors, all they were concerned about was technology stocks. And again, just showing it in a slightly different way here, looking at the Russell 3000 value relative to the Russell 3000 growth index. There was a little bit of a turn up at the beginning of November last year when the vaccine trial data went on, but value stocks tend to do better and perform better when economic growth has been slow but is starting to recover again, or when yield curves are starting to steepen. So when longer term interest rates are rising at a faster pace than shorter term interest rates. I think both of those developments are something which you can easily forecast is likely to happen in 2021. And therefore, we think actually rotation, at least to part of the portfolios, away from perhaps tech, away from growth and towards value, is going to be something that we need to consider. And in fact, we started doing that process. We started doing it last year, and we continued this year by just taking a little bit of money out of technology stocks. Not taking it out completely, but just starting to rotate some of that money. For us, we're also taking a look at markets outside of the US. We're viewing them much more attractively than we are than the US at the moment. That partly reflects valuation. So again, comparing here the P of the US stock market compared to Europe, Japan, Asia, and emerging markets. Actually, these stock markets offer better value, and better value by most metrics. And also, again, just looking at the sector composition of markets outside the US, it is likely to be more favorable in the economic and investment environment that we expect in 2021. So we're looking at the US stock market, again, it's dominated by technology. Actually, markets outside the US have a much lower weighting to technology, but have a much higher weighting to things like financials. And again, sort of stocks that you would expect to outperform if the economic recovery continues into 2021. Lockdowns are eased, and we see a return to more normality, and value stocks begin to outperform. I think it's reasonable to expect that actually countries outside the US, which have lagged for quite an extended period of time, will begin to take up that mantle of outperformance. And actually, one of those countries is also the UK, which we're starting to take a look at within our funds for the first time in a very long time. UK stock market has significantly underperformed over the past few years. And we think it's starting to look a bit more attractive again, not least because we have started to see an increase in M&A activity. With some of those uncertainties like Brexit now out of the way, we wouldn't be surprised to see the UK stock market begin to outperform. And then just looking at the US dollar, It's a bit of a consensus view, this one, but it's very difficult to make a case for why the US dollar is likely to strengthen moving forward. All of the indications are that the dollar's likely to decline. The US dollar is typically what's known as a counter-cyclical currency. So as global activity strengthens, the US dollar typically weakens and vice versa. So if we do see that economic growth coming through, the US dollar will likely weaken. And also the dollar tends to move in sort of relation and correlation to the deficits which are being run, both from a current account and a fiscal basis. So here again, just showing the correlation between those two factors. And with the massive increase in deficits that we've seen in the US, then again, it's reasonable to expect, I think, that the US dollar is going to continue to decline. And as a result, yeah, it's one of the reasons why we still have gold within our portfolios, which we think is going to serve a number of purposes. One is that uncertainty hedge. B, we also think it could benefit as the US dollar continues to decline, and also actually as an inflation kind of proof asset. Actually, over the very long term, gold doesn't do a good job of protecting against inflation, but actually does do a relatively good job over shorter periods. So actually, if we do start to see inflation come through again, actually gold could hold up reasonably well on that basis. So just bringing everything together, and we're happy to then to open it up to any questions that there may be. There are always positives and negatives. I think the key message I would want to leave with you is that we do expect that 2021 will still be a positive year for equity markets in particular. It's just that we believe actually the winners of 2020 won't necessarily be the winners in 2021, and that we're feeling we have to take some portfolio activity. We're having to make some decisions and implement some portfolio activity as a result. On the positive side, the fact that we've developed a vaccine and it is being rolled out across the world is undoubtedly a game changer. There's lots of noise out there, as I've mentioned, about effectiveness, how long protection will last. But I think even the fact if we have to go through a process of being inoculated or vaccinated once a year to provide the boost, again, the world will cope with that. I think most people now are just wanting to get back to some sort of normality, and will be prepared to accept the restrictions that might be imposed as a result. So we're going to get that. We're going to get economic reopening. At the same time, we are still going to see this monetary and fiscal stimulus, all of which is likely to feed through to stock prices. We believe, particularly as policymakers have been as clear as they possibly can be, particularly in the US, to say that interest rates are not going to be going up anytime soon. And even if there is a temporary increase in inflation, they are going to be prepared to look through that. They view it as kind of one-off factors, and they want to see much more economic resilience before they'll even begin to think about raising interest rates. And ultimately, we could be at the beginning of a brand new cycle. We know bear markets typically begin when the US Federal Reserve raises interest rates to such a level that economic activity begins to be choked off. Arguably, we're a long way away from that situation quite yet. On the downside, things we have to monitor. Some of that economic damage that we've seen is going to take a long time to potentially repair. Some of the jobs which have been lost simply aren't going to be there for people to go back to. So that needs to be factored into consideration. And again, it might take a while for these unemployment levels to fall to the sort of levels that we saw in 2019. We've still got issues in terms of the vaccine, in terms of, again, as I mentioned, how long it's going to last for, how long the protection will last for, and how effective it is against new variants of the virus. And again, in certain markets in particular, a lot of the good news seems to have already been discounted. So again, just mind your eye in terms of the price that you might be asked to pay for certain investments, because that's a very important, or the most important determinant of future returns. And then we've got the geopolitical issues, which haven't gone away, but I think they have dampened down. So that's our view. In summary, 2021 we think will be a good year. Remain committed to equity markets, but just have a little bit of think about whether some sort of portfolio rebalancing is necessary. So with that, thank you very much for your time and attention, and I'm very happy to open it up to any questions.
Thank you very much, Justin, for that very, very informative presentation. We do actually have a number of questions. We got 2 from Joseph and 1 from Ria, so I'll just run through these. When assessing the high price of US stock markets in terms of PE or price per sales, don't you think both earnings and sales have been affected to the downside by lockdowns, therefore showing higher multiples compared to what would have been if no lockdowns happened?
It's a very valid point, which actually in terms of the PE ratio, which is partly why we look at the forward PE ratio, again, because it's taken into account future estimated earnings to try to reduce that cyclicality. Again, that's a perfectly valid point. PE multiples can be very high as a result of cyclical contractions in earnings and profitability, which is why also we pay attention to things like the cyclically adjusted price earnings ratio, which has clearly been constructed to try to reduce the disadvantages, as has been perfectly highlighted, of the PE ratio itself, which is just looking at 1 year's earnings, which could be unduly impacted by cyclical factors which will resolve themselves. What we've tried to show there is on virtually any metric that you look at, the US stock market is not cheap. It's only where you compare it to interest rates that the valuations could be said to be offered support.
Okay, thank you. Second question from Joseph. Also, could you comment on how one could approach sectors which have had parabolic growth, EV and green energy mainly? Take exposure for the very long term, assuming short term drop potential, or leave the sectors and invest once valuations are more reasonable?
Yeah, very good points, Joseph. I'll tell you what our position is that we do have exposure to those sort of energies. We've got an ESG weighting within our funds, and I think there's a big danger in trying to time switches into and out of particular areas. We struggle with it, and we're looking at things clearly on a sort of day by day basis. I think timing doesn't necessarily add value, so I'd be prepared to look through any short-term volatility. Wouldn't try to time it too much, but be aware that maybe the price you're paying now isn't going to be rewarded for a year or so. But ultimately, take a step back. The ESG, should I call it a revolution? I don't know. The ESG sort of themes within portfolios and the focus of the investment community on it is not going to go away, and therefore we do think that there's secular tailwinds behind ESG related investments. So what we're doing is not trying to be too clever and time our moves in and out. We're viewing it as a longer term part of our portfolios and live with the volatility as a result.
Okay, thank you. And finally, a third one from Ria. Would the entire 2021 be a growth year, or do you think there will be a peak at one point and a potential crash? Is this a year to hold on to stocks or watch timing?
Okay, I think it's reasonable to expect there'll be a bit of volatility in 2021, certainly beginning half of the year, because markets have moved quite fast in quite a short period of time. So some sort of pullback is, I think, likely. But as I tried to wrap up in the summary, I think the fundamental position is still one where the outlook for 2021 in particular, I think, remains positive, because we are going to see a move out of lockdowns at a time when we're still seeing massive amounts of stimulus being applied to the global economy, and that's not going to change anytime soon. So I think stock markets should continue to make ground this year. Bit of short-term volatility is possible, but it's possible at the best of times, quite frankly. I think the biggest determinant of future returns will be both obviously where you're invested and what you've invested in, which is why we're starting to take money out of the US, looking at other areas, and also looking at growth stock to value stock split that we've got within our portfolios, just starting to shift some money away from one part into the other.
Okay, thank you very much, Justin. Again, thank you for everyone who participated today. Some really good questions. Alex, would you like to say a final word?
Yeah, of course. Thanks again, Justin. Excellent presentation. And it's nice to finally see a crypto graph in your presentations. I think that's the first one we've ever had. So yes. Thanks a lot for that. Awesome. Everybody, hope you found it useful. Some great information in there. But yeah, thanks a lot from us guys. You've put a lot of effort into that, so I thank you sincerely. Everybody have a good day. Thanks a lot.